Hello future CPAs. Today we're going to go through the top 10 multiple choice questions that you could find on the audit exam. And I'm going to give you my full perspective on solving them that led me to getting a 90 on the exam. In these questions, we'll go through everything from testing the completeness assertion to finding tricky audit opinions to changing your control risk assessment. So with that, let's jump in. Let's start out with an audit opinion question. Faced with this situation, the auditor would most likely choose between issuing A. During an audit of Lavender Limited, the auditor finds that the accounting records for a substantial portion of sales transactions are inadequate, preventing the acquisition of sufficient appropriate audit evidence for these transactions. So here we have a scope limitation, meaning that we do not have enough audit evidence. So as soon as you identify scope limitation, it's between a disclaimer of opinion and a qualified opinion. A qualified opinion is if you have a non-pervasive scope limitation, and a disclaimer of opinion is if you have a pervasive scope limitation. All the other answers are some combination of a gap departure and a scope limitation, or for example, you only issue an emphasis of matter paragraph if you are issuing a unmodified opinion, but you don't ever issue it if you are modifying the opinion. So as soon as we see scope limitation, we go between disclaimer and qualified opinion. This next question is about performing alternative audit procedures. In this situation, what type of audit opinion should the auditor consider issuing? An auditor was hired to audit the financial statements of Maple Inc. for the fiscal year ending December 31st, 2024. However, the auditor could not attend the year-end inventory count due to timing issues. The inventory is a material aspect of Maple Inc.'s financial statements. Despite this, the auditor successfully performed alternative audit procedures and obtained sufficient appropriate audit evidence regarding the inventory balances. So as long as we can actually perform alternative procedures and we get the evidence we need, then there's no need to actually modify the opinion. So we couldn't observe the inventory, but we could get the audit evidence another way. So that is completely fine. There's no reason that we need to actually modify the opinion. So there's no need for qualified opinion. That would be if there's a non-pervasive scope limitation. This is not involving any kind of gap departure or anything they did wrong. It's just a limited amount of audit evidence. So this would not even be in the options. And then this would be, for example, if we couldn't get the alternative audit procedures and it was a pervasive amount. Do you want to master CPA topics like the one in this video? Our team of CPA tutors provide one-on-one personalized sessions to meet your needs. We've already helped over 1,500 students pass their exams, and we want to help you too. You can book a session here. What audit objective is primarily being addressed by this procedure? During an audit of Henderson Corporation, the auditor performs a procedure where they trace several bills of lading to corresponding sales invoices. So we need to think about what these documents are and what order they are tracing them in. A bill of lading is a shipping document that's going to show you the terms of the shipment and what is being shipped. So if we have a bill of lading, it means we actually shipped something. And then the sales invoice is what we create after the shipment to actually bill the customer. So we're going from an earlier step to a later step, which always means that we're testing for completeness. Because imagine if we had the bill of lading for an item, but we never created the invoice. That would mean that we have a legitimate transaction, but we never actually recorded it to the books. So then we have a completeness issue because we're missing something from our financial records. So the main objective is confirming that the shipments to the customers were actually invoiced, that we properly invoiced them and didn't miss out on any of the shipments. Now A is pretty close, but it's just slightly off, ensuring that all goods dispatched have been recorded as sales. It's not quite as specific. Also, the invoice is going to happen and then we make the journal entries for recording the sales. So this happens just slightly after we are making the invoices. So it's just not quite correct, but it's almost correct. Then B is verifying that all recorded sales are supported by shipping documents. This would be like for the existence assertion, because we're trying to make sure we have a sale. Now we go back in the process and take it to the shipping documents to make sure we actually did ship something, that it is a legitimate transaction. And then D, checking the accuracy of inventory count and valuation. This is not a part of this process. This would be actually doing a physical inventory observation and looking at the valuation, such as looking at the purchase documents of your inventory. But it's not related at all to this completeness assertion that we are testing. This next question asks, which of the following audit procedures would an auditor most likely perform to test controls related to management's assertion of the completeness of sales transactions? So we're worried about a sales transaction that actually took place, but it never gets recorded on the books. So we're testing completeness for sales, so we need to go from an earlier step to a later step in the process. And let's think about what happens when you're looking at pre-numbered sales invoices. So imagine that you have a gap in your sales invoices. So you have, let's say, 101, 102, and then 104. So the question is, what happened to that invoice that is 103? It could be that invoice has been deleted or omitted. So we had a legitimate shipment, and then the invoice was maybe put into draft mode and then deleted, or initially put in but then deleted, or just omitted overall. But the key is that if it's missing, then the transaction never gets recorded in the books. So we never record the revenue into the books because we have a missing invoice. Let's look at the other incorrect options. Examine a sample of shipping documents and trace them to the purchase order. This is talking about the perspective of purchasing, but this question is about making sales. So making sales is about the perspective of the vendor, and A is about the perspective of the client that's purchasing. So it's just a completely different cycle that's talking about. B is review a selection of sales invoices and compare them to the shipping log to ensure that all billed sales have corresponding shipping records. This would test the existence assertion because we're looking at the sales invoices and making sure that they have proper support and that they actually took place. And then D, assess the consistency of sales invoice processing by checking for proper authorization and recording of sales transactions in the sales journal. Looking at the authorization is going to be looking at who has the ability to actually sign off on these transactions. But it doesn't tell us anything about whether our sales invoices end up getting recorded into our revenue. So it's a good control, but it's just simply not addressing this completeness assertion. It's looking at just having the proper authorization, having the proper segregation of duties. I want to give you a foolproof method for remembering the completeness assertion. Let's picture the timeline of a typical revenue transaction. First, you ship the goods. After you ship them, you invoice the product, and then you make the journal entries to debit AR and credit revenue. So if you're going from an earlier step to a later step, then you're testing for completeness. For example, if we look at our shipping documents and then want to make sure we actually created the invoice, then we're testing for completeness. Because if we don't create the invoice, then we never make the entries, and so we have something that is missing from the financials, so they are incomplete. In the opposite way, if you're going from a later step to an earlier step, then you're testing for existence. So if you look at an invoice and you want to make sure that it was an actual legitimate transaction, you then go back to the shipping documents to look at the proof. So try this method next time you're trying to distinguish between the completeness assertion and the existence assertion. This next question is about searching for unrecorded liabilities. In the process of searching for unrecorded liabilities at year-end, which of the following would an auditor most likely examine? So we're talking about accounts payable and the company under-reporting them. So the best way to see whether we have unreported liabilities is to see what obligations we have and whether we actually recorded those in our year-end AP aging or not. So with A, receiving reports for items received before year-end but not recorded as liabilities. We have a receiving report when we have purchased something and now we're receiving it in the warehouse. So as soon as we receive the goods, we have an obligation to pay them. So if we don't have recorded as liability, then we have understated liabilities. B is cut off bank statements for checks issued just after year end. This is a procedure for testing the bank reconciliation. because at year end you're going to have some deposits in transit and outstanding checks, and then you look at the following month's bank statement to see whether those cleared or not. C is invoices received and recorded in the subsequent period. If you're receiving invoices in the subsequent period and you're recording them in the subsequent period, they don't even belong to year end. So they're concerning that following year, but not the year end activity. And then D is correspondence with legal counsel regarding potential lawsuits. This is not talking about unrecorded liabilities like for accounts payable. It's talking about contingent liabilities like a lawsuit, and just seeing whether we need to actually record the lawsuit or not based on its probability of occurring. This question makes us think about the segregation of duties. Which of the following scenarios most likely represents a weakness in an entity's internal controls over its payroll process? So when we're thinking about the payroll process, we're thinking about the HR department, who has the authority to hire individuals and to change the pay rates. So that's like the authorization. Then we have the payroll department, like the accounting clerks, and these have the record keeping responsibilities. These are the ones who are going to be making the entries for our payroll expenses, and they're going to be preparing the payroll report to then forward to the treasurer, who then has the custody function, because the treasurer is going to be actually distributing the checks. So it's important that the person who's recording is not also distributing the checks. So in D, we see the employee who distributes payroll checks is also responsible for updating payroll records, including hours worked and rates of pay. Because they could, for example, create a ghost employee that's fake and then collect their paychecks. They could inflate hours or pay rates and then take the overpayment from that. They could process payments for terminated employees, and then they can manipulate payroll records to conceal all of their activity. So it's important that those two roles are not combined. A, we have unclaimed payroll checks are stored in a secure location. That's great. B is the payroll department sends them directly to the treasurer for signing without independent review. We don't really need an independent review. It's just important that the payroll department that has recording ability is not also the one who has the custody. So that's okay. And then C is the human resources department is responsible for informing the payroll department about employee terminations, but there's no process for cross-verification. This is, again, something that would be nice to have, but it doesn't mean that they have a weakness in their internal controls. So I want to emphasize the importance of segregation of duties. We have authorization, which is the person that is signing off on transactions like a purchase order or a sales return. Then we have the record keeping, which is the individual making the journal entries into the accounting system. Custody is the individual that actually has the contact with checks that you're paying to employees, or if you're talking about the warehouse, they have custody over the inventory items. And then you have reconciliation, which is a person that is going to be reviewing the overall cycle. So these should never be combined, because then someone could commit fraud and then cover up their tracks. Now we need to think about control risk when it comes to testing controls. Because this question asks, during an audit, if an auditor erroneously assesses the control risk as too low, what is the most likely reason for this incorrect assessment? So when it comes to sampling for internal controls, there are two different risks. The first risk is that we assess the control risk as too low. So in other words, we think we can rely on the controls when we actually can't. So what this usually means is that we test a sample of transactions and those look reliable. So then we think the entire population is reliable and we can reduce the control risk. But then it's actually not true, that the sample is either too small or it was just the sample that had fewer deviations than the rest of the population. So then if we think about the impact of this on our audit risk formula, if we assess control risk as too low, we think we can rely on it when we can't. Therefore, we're going to increase our detection risk and do less substantive testing than we should be doing. So A says the auditor overestimates the operating effectiveness of the client's control activity. So this is the case. We overestimate it. It's not actually operating effectively. Therefore, we're not doing enough substantive testing. B is the auditor underestimates the operating effectiveness. So if we underestimate it, that means we're going to assess control risk as too high. So we think it's not reliable when if we actually looked at the population, we'd see that it is reliable. So this is the opposite. This is the other control risk. So then if you assess control risk as too high, then you're going to have to lower your detection risk, and therefore you're going to do too much substantive testing. C is similar. It says the auditor incorrectly assumes that the control activity is not relevant. If it's not relevant, then we'll simply assess control risk at its highest level. Then D is the auditor incorrectly anticipates that the control activity will significantly reduce the necessity for substantive testing. So this is simply describing the consequence of assessing control risk too low, but it's not the cause of assessing it as too low. This next question also makes us think about the audit risk formula. An auditor during the course of an audit finds that certain key control activities are not functioning as expected, and therefore increases the assessed level of control risk. As a result of this assessment, which of the following would the auditor most likely increase? So here we are going to raise the level of our control risk because they're not functioning as we expected. We can't rely on them. So when you are putting your control risk at its highest level, that means you need to offset it by decreasing your detection risk. So what a lower detection risk means is that we have to accept a lower risk that we do not detect something. In other words, because we can't rely on the controls, we have to put more responsibility on the auditor substantive testing, so we have a lower chance that we miss something. So in order to decrease the detection risk, we need to increase the extent of our tested details, or we need to improve the nature of our tests, or we need to improve the timing of it by doing more year-end testing instead of more interim testing. Level of detection risk in option B is what is decreasing, is not what is increasing. Then C is level of inherent risk. So inherent risk is based on the nature of the entity's business, industry, and transactions. So it's independent of the internal controls and the detection risk. And then D is extent of tested controls. So this is just too late in the process because we've already determined that the controls are not working as they should. So we don't need to do more tests of controls. We're already past that point. We know what control risk is, and now we're moving on to detection risk. Next, we have a SOC report question. Which of the following reports should the auditor provide to satisfy the client's needs, especially regarding the suitability of the design and operating effectiveness of the controls over financial reporting? A technology service provider furnishes data processing services to a variety of clients. One of its clients, a publicly traded company, requests an external audit of the service provider system to gain assurance about the effectiveness of its controls related to financial reporting. That's the key wording that tells us everything we need to know. The service provider engages an auditor to examine and report on the system's controls. Okay, so the first question is, do we need a SOC 1 or SOC 2 report? And SOC 1 reports are for controls related to financial reporting. So we know it's going to be a SOC 1 report because a SOC 2 report is talking about a report for non-financial reporting, such as data security, availability, processing integrity, confidentiality, and privacy. So that's not related to this scenario. And then we need to ask the difference between type 1 and type 2. So a type 1 report is not as reliable as a type 2 because a type 1 is just talking about the design suitability of the controls. It's not giving an operating effectiveness. So it's not saying that they're operating effectively. It's saying just whether the design is good or not. Whereas a type 2 is actually telling you about the operating effectiveness. So we can actually rely on this report to lower our control risk. So this specifically says the effectiveness of the controls. So that's why we need SOC 1 Type 2 report. Now we've made it to the last question on segregation of duties. Which of the following scenarios demonstrates an effective segregation of duties in a company's internal controls? So we're thinking about keeping the record keeping separate from the authorization, separate from the custody, and separate from the reconciliation as well. B is an accounts payable clerk prepares checks but does not have authority to sign them. So this is great because they're preparing the checks, they have this record keeping ability, they're making the journal entries as well, but they're not able to sign them, which would be the treasurer who's signing them and then sending them out. Let's look at A, C, and D of why they are not effective segregation of duties. A is the cashier who handles cash receipts, custody, also reconciles the cash ledger at the end of the day. So they're both handling the receipts themselves and reconciling the receipts too. So we have improper segregation of duties. So this person handling the cash, they could misappropriate funds and then conceal the theft during their reconciliation. C is the inventory manager is responsible for both ordering inventory and receiving goods. So they have the authorization to order and then the custody of receiving the goods. So they could order goods for their personal use, or they could accept fewer items than what were ordered. So effectively they could steal from the company. And then D is a salesperson records their own sales transactions and adjusts customer account balances. So they have this record keeping, and then they're also doing this reconciling of the customer accounts. So they could record fictitious sales, for example, to earn higher commissions, or they could manipulate customer accounts to conceal theft or errors. So you can see in all three of these the opportunity for theft and covering your tracks, which is why effective segregation of duties is so important. So if any of these questions didn't make complete sense to you, then you need to spend more time digesting the material, which is why I have my Accounting 101 free course, which you can sign up for and get access to the same quiz that we've been talking through in this video. So spend time with the concepts, digest it, because these are very likely going to show up on your audit exam. As a final closing thought, the audit exam is not testing your ability to memorize facts, but it's testing whether you can adopt the auditor's mindset. The best way to think like an auditor is to start asking what and why. What procedures would best test this assertion? Why does this procedure help us to address this risk? Why does this internal control deficiency cause a potential risk of fraudulent transactions? The more you internally ask yourself these questions, the more you actually adopt the right perspective of the auditor's mindset.